Hello all. In this video, I'm going to talk about extension adjustment for options trading. So without any further delay, let's get into the video. Let me explain with the StockMark website. It's a backtesting website for options trading. Now I have taken 6th of October 2023. So which is Nifty 6th of October 2023, this candle. Okay. Here I have selected 13th November as a expiry. Okay. I will just go and select the ATM straddle. I have taken an ATM straddle here. Okay. Now I will make my adjustment if the market breaches one of my break even. Okay. So now the break even is 19,075. You can see, right, downside break even. Now if market comes to 19,175, that is 100 point from the break even. If the market come to 19,175, then I will start my adjustment. Okay. Now here, after taking on 6th of October, there is no upside movement after that, but the downside movement, it came to 1975. You can see this in this candle, it came to 1975 around this range, which happens to be 25th October 2023. Okay. Let me go through this straddle. On 13th, okay, the 1200 profit. On 20th, 4000 profit. Okay, the market doesn't move much there. We have to see the 25th where the market came down. Okay, this is 19,132. The market came to 19,132. Let me start the adjustment. So what you have to do here is just go to the expiry. Okay, now this is our original expiry, 13th November. Since the market is coming down, we have to buy the put option to protect from the downside. So before buying the put option, we have to sell some put option. Okay, now here if the market is at 19,175, we have to see where the support is, near support. Okay, I can see that here 18,600 as a good support. So I will go and sell 18,600 2 lot. That is two lot. 18,600 put option I am selling at 93. 2 lots I sold 2 lots. Okay. Now you have to buy almost the same number of premium we received. That is for 93 into 2, which comes to, it will come to 186. So around that we have to buy the options which is near ATM. So I will go and buy this 221.9 option, put option. Okay, now you can see our break even has widened up to 18,600, which is a major support. As we saw in the chart, we will only lose 552 rupees only if the market closes anywhere between the 18,600 and our original upper break even. We will lose here only 552. Okay, let's see how this performed. So okay, now the 26th of October, the market came down really well. Okay, we saw a 10,000 loss. Now after that, it started recovering. As you can see in the chart, it starts to move up. And 3rd November it starts to move up. So now you might have two questions. For this adjustment, you have to put on an additional money, because this is, you can see, without this simple straddle will cost up to 1.5 lakh. But by adding this, you will have to pay 2.28. That means about 80,000 you have to add on additional margin for this to take your adjustment. So this is not a free adjustment. You need to have additional margin to take this adjustment. Okay, one point. Another, if you take the adjustment and the market starts to recover, then you need to close this adjustment, because this adjustment will not give much loss when the market recovers. As you can see, the loss is 1,800. So you need to close this when the market recovers to your original straddle position. You can get it, right? If the market recovers to original straddle position, you cut this adjustment, because this adjustment is around 80,000 you have to pay additional margin. So by cutting this you will get your original margin and you will free up the margin. You can trade some other trade with this additional margin. So if the market recovers to the straddle price, you will close the adjustment. Okay. Now if market goes and breaches this support which we considered 18600 P, now what you have to do, I will explain in the other example. Okay, for this example, let's say I hold up to November 10th, so the profit comes to around 11,000. That's a good profit for 1 month. Now let me explain the other example. For this example I have taken here 17th February 2023. So this candle right here is 17th February 2023. Okay, let's take a expiry 29th March expiry, and I will go and sell the straddle, ATM straddle. Okay, now the same logic here also. If the market comes to my lower break even or upper break even, I will do the adjustment. Okay, let's see, the break even is at 17,464. Let's say I will start adjusting this break even plus 50 point, that is 17,514 rupees. Okay, let's see where it came. On 23 February the market came there. 23 February. Okay, it's almost to the break even price, so I will start adjustment here. 29th March, that is our expiry. Okay, now we have to see what is the immediate support here. From 17,514, the immediate support I see is around 1700. Okay, to take 1700 I will take 17,000 as well. So I will sell 17,000 PE 2 lot, and which came about 101 rupee. So into multiply by 2, it will came around 202 rupees. Now 17,500 put option is trading at 236 rupees, so I will go and buy this. Okay, now you can see here our break even extends up to 17,000, and in between we only there is no loss no profit, nearly 137, which is negligible, but there is no loss no profit up to 17,000. But if it came back to our level, we will be profitable. So with this extension we are improving our probability of profit. That is the beauty of this adjustment. Some days rarely you lose money on this adjustment, but most of the time you will make money with this adjustment. Now let's see when the 17,000 came. 17,000 breached on 15th March. Okay, on 3rd of March we were in profitable. On 10th of March we were in the same position, but we are in loss. On 15th March we breached the 17,000. Okay, okay, now the market is at 17,030 rupees. So I will start my adjustment here. Now you can see this is almost 15,000 loss. Now what you have to do is simply buy the strike which is next to our sell strike 100 points away. So 70,000 is our adjustment sell leg. So you have to buy the 17,900 which is next to 2 lot. Okay, if you buy this 2 lot, your maximum loss will be 23,000 on the market downside. So if it recovers, your loss will keep on reducing, but if it goes above 6,900, your maximum loss will be 23,000. This is extremely rare case, but let's see how the market went. So you can see the market, after that the market does not move much. It's let's say I closed my positions on 24th of March. As you can see, if I would have closed this position on March 24, my booked loss will be 16,700. Okay, so this is how you have to close this adjustment. So if you take the adjustment, then the market recovers to the standard price, you will close the adjustment. If market does not recovers, coming back to the adjustment sold position, we have to buy the strike which is near to them to strike. By buying this also, we will limit our margin also. So margin also will be released from this. For upside breaching, you just have to do the opposite, where you have to buy one ATM call option, buying ATM one call option, sell 2 out of the money call option. That's it. You just have to create a ratio to protect the upside. Since the options trading has unlimited loss on both sides, you have to trade with weekly protections. That means you have to buy the far out of the money weekly options to protect you from black swan event, or you can use VIX as a hard stop loss. That means if VIX, that is the volatility index, goes above 30, you will close all your option positions regardless of profit or loss, and trade this adjustment only with the Nifty, because Nifty moves does not move much, so it will be useful for us to adjust our position easily on Nifty rather than stock or any other index. That's it for this video. I will come up with another interesting video next time. Until then, bye.